Well, Vasileios, I need to start with Japanese yen, which a vengeance has moved two big figures from a 106 down to a 104, ready to breach 103. Right now, 104.10. Explain to our audience what yen and yen strength signals.
Well, that's absolutely right, Tom. I think what we've seen in this broad-based rally against the dollar, the yen has actually lagged. And I think right now it's playing catch up. And as a matter of fact, if you look at the historical patterns, if you look at what has happened in previous dollar down cycles, what you find is that initially the yen is not the first currency that actually responds into dollar depreciation, but yen appreciation comes a bit later at a more mature stage of the dollar depreciation cycles, potentially because the cycle becomes a bit more mature, potentially because participants adopt a more risk-averse appetite.
Well said, but this is critical for global Wall Street, Vasileios. What is the level on dollar-yen that signals that new maturity? Is it to breach 100, to breach the major level?
Look, I think it is possible. Our forecast is that we're going to approach 100 by the end of the year. I think potentially the 100 level is going to be a level at which Japanese authorities may start making some noises, because obviously they're going to be concerned about the pass-through impact to an already extremely subdued inflation outlook. So I think it is possible. A central scenario is that it's not. It will also depend on the global macro backdrop. If we get a severe resurgence of the pandemic, which is still not our central scenario, then we could easily see dollar-yen to 95.
Vasileios, noise is not the same as policy, so let's talk about it. Euro-dollar 120, we heard the noise. Dollar-yen 100, your call, we start hearing some noise. Can you talk to me about policy, what the follow-through looks like, either from the ECB or the BOJ?
Well, look, in both cases, the reality of the matter is that the room for policy maneuver is very, very limited. One thing about the euro that we need to take into account, the ECB watches predominantly the trade-weighted euro. And if you look at the broad trade-weighted euro, you can actually see that it's been rising for the past 2 or 3 years, not the past 5 or 6 months. And the reason for that is strength of euro versus EM, or more likely EM weakness, which is not really something the ECB can do. But on a more ECB-centric basis, the issue for me is that if the ECB starts making noises, as you said, verbal intervention, they have to be sure that they can actually follow with some credible policy response. And in this case, I'm not entirely sure, or let me put it this way, I think it's extremely hard to walk the talk. The room for policy maneuver is very limited. I expect that on an idiosyncratic basis from governing council members, we're going to hear some verbal noises and verbal intervention that are likely to act as a speed limit to the euro. But I think we're not going to see any, for example, rate cut by the ECB.
So, Vasileios, what I'm trying to think about, if we go through some choppy waters, it's early days. It's one day of this kind of price action of some real concern. Politics in the United States, restrictions over in Europe. What's the pressure valve in G10? What is the currency that everything else rallies against and there's not much pushback? Traditionally, it would be the US dollar at a difficult time. What is it now?
Well, I think for the time being, it remains the dollar. It is just that the pace of dollar depreciation or the pace of other currencies' appreciation against the dollar is likely to be far more slower than it was before, largely because the move has been very abrupt, largely because there's been a lot of positioning by speculators. We are talking about extreme dollar short positioning. So I think if you want to talk about the pressure valve in case of, the economy is managing to recover further, that definitely remains the dollar. But I think that from now on, it's going to be more of a two-way price action as opposed to a one-way street that it was over the past 5 months or so.
Vasileios, let's build on that, this idea that if the dollar still is the haven, then have cries for the devaluation going forward in the next year or 2 years with turmoil in the U.S., has that all been overstated?
I think that's a fantastic comment. I think we need to separate the cyclical from the structural here. Although I do have some sympathy about the structural argument for the reduction in dollars dominance on a multi-year basis, I don't think we necessarily need to utilize that argument to explain the dollar's decline over the past 5-6 months and potentially a further depreciation from here. These are very, very sticky money we're talking about. We're talking about global currency reserves. We're talking about asset managers that move these monies and these weights into different currencies at a very, very slow pace. This is not really what's been happening in the FX market. The dollar was overvalued. It included a number of risk premia, initially trade wars, then the pandemic. And now as these things get normalized and get priced out of the market, that's exactly what's happening. And on top of that, you have the Fed that pretty much has told us that they're going to be in zero rates for at least the next 3 years.
Well, but so let's push that toward the election. Almost every analyst comes on and says that they expect more volatility. We're certainly seeing that today with the political turmoil in Washington deepening. Does that mean the dollar will likely strengthen heading toward November 3rd and thereafter rather than weaken, even though the turmoil is based in the U.S.?
Look, I think if in the run-up to the elections, I think a lot will depend on the opinion polls. But at the same time, as I said, the build-up of short positioning is quite extreme. So I think I would expect to see a significant pickup in volatility. In the aftermath of the election, that will depend on the outcome. I think if we get a Democratic sweep, we're going to get the pricing in of an unwind of the corporate tax cuts that we've seen with the Trump administration, and potentially an unwinding of some of the tariffs that have been imposed to China. So I think this will be perceived to be good for currencies that depend positively on global trade, and euro is a prime example of this. So I think it's going to be good for the euro and bad for the dollar.
Vasily, tell me about the dollar dynamics in the reality of such a low nominal yield, inflation break-evens rising, and then a real yield that is hugely negative. What does that do in your world?
Well, it's definitely putting immense pressure, not only on the U.S. Real yield or nominal yield, but also on the U.S. versus the rest of the world yield differential. And on that account, if we try to model historically, although I do take the point that there might have been some structural changes in the relationship between yield differentials and the dollar, what's happened, and that's the bit of that is interesting, the dollar has collapsed by 10% over the past 5 months, but the differential has also moved further away. So by our estimates, we're talking about a dollar, trade-weighted dollar, that it's still about 14% overvalued. Now, to the extent that, we don't see the world going into another pandemic or another black swan, then I think that correction of that dollar overvaluation, of that misalignment gap, is going to continue.
What is the Erdogan tipping point? And Vasily, as I'm sure you've watched now, we've just gone out to new weakness, 7.61 on Turkish lira. I just don't buy the idea it's idiosyncratic and discrete. When does this become important, this profound weakening of Mr. Erdogan's lira?
Well, as far as Turkey is concerned, it has already started to become the tipping point. You can actually see in the rhetoric on several fronts. For example, we have had an escalation between Turkey and Greece over the summer that seems to be panning out a bit, although a lot of questions remain. But it is undoubtful that we have now the economic reality is biting into politics. And I think we've started reaching that tipping point at which these things will have to be taken into account into a number of political levels. That being said, the story for the Turkish lira remains one which is extremely difficult. On one hand, it's very, very difficult to short it because of the negative carry if you short it. But on the other hand, if you look at central bank reserves, they're simply not there to prevent a significant depreciation of the lira, which is going to have tremendous ramifications to the banking system and the real economy.